just how rewarding has it been for the long-term investor? Right now, there's so much focus on the short term in the stock market that I thought maybe a dose of optimism and a little bit of long-term perspective might do us all some good. So today we're going to talk about specifically rolling investment returns and how rewarding that these can be the more time that you have as an investor. So rolling returns, these are basically a series of overlapping periods, and then you calculate the investment return for each period. So for example, let's say we're calculating rolling 10-year returns. We take the first 10 years, calculate the return, and then we would shift the window forward 1 year, calculate the return for that period, and then so on. So the idea is that there's just as many 10-year periods, right, each iteration, as there are 1-year periods. So we aren't just cherry picking out the good returns. And what this does is it smooths out those short-term fluctuations, and it helps us really evaluate the potential rewards of being a long-term investor, but takes into account an element of timing risk. What if I just had bad timing? So before I bombard you with a bunch of data, I want to give credit where credit's due here. Ben Carlson from Wealth of Common Sense blog, he put together a lot of these numbers, and I've adapted for this video and also for my clients. So over the last century, definitely seen a lot of volatility in returns. So I'm going to break down the 10, 20, and 30-year rolling return periods. We'll talk about the 10-year stretch first. So the best 10-year period to be an investor in the last 100 years made 21.4% a year, ending in 1959, total return of 600% of your initial investment. On the flip side, the worst 10-year period showed a loss of almost 5% a year, ending in 1939 at the bottom, near the bottom of the Great Depression, where you lost about 40% point to point of your initial investment. But what's interesting here is if we stretch this out to a 20-year rolling period, we don't see a single down iteration. With the best 20-year compounded return at over 18% per year from the early 1980s to the spring of 2000, where the worst 20-year return was a gain of less than 2%. So you still made money ending in 1949, basically because you had to endure the Great Depression and World War II. But nonetheless, you still made money over that time frame. And also, as just an additional fun fact, in over 90% of those 20-year periods, the average annual returns were at least 7% or higher. And again, there was never a negative period. Now for my favorite chart, the rolling 30-year annual returns. The lowest annual return over any 30-year period going all the way back to 1926, still compounded at 7.8% a year, beginning of September 1929 at the peak of the Roaring 20s boom, and you would have lost 80% of your initial investment in the ensuing crash. But if you held on, you still made more than 850% over those 30 years. So to say it another way, if you had the worst timing of anybody in American history and invested, let's say, $100,000 just before the Great Depression, your initial investment would have shrank to $20,000. But if you rode things out and didn't sell, you still had $850,000 30 years later. Now this was over a time period, right, where a third of the world was unemployed in the Great Depression, and then World War II happens and half of Europe is leveled. So it makes sense that that would be the worst 30-year period. Now on the other hand, the best 30-year return was up 14.8% per year in the 30 years ending in 1968, which makes sense because 1938 would have been near the bottom of the Great Depression. And while the difference between 7.8% per year and 14.8% per year doesn't sound like a big difference, over the long run, it really is. So instead of your 100 grand growing to 850,000 in our worst period, if you had the best timing of anybody in history, that $100,000 would have grown to over $6.2 million. And even despite a bunch of negative events like Asian currency crisis, dot-com bubble, 9/11, great financial crisis, the biggest global pandemic since 1918, and much more recent returns have even been strong. Most recent annual 10-year return through January of 2023 compounded 12.7%, and then the 20-year period at 10.3%, 30-year at 9.8%. Now, obviously, we can't predict the future, but when I look at numbers like this, it's hard for me not to be optimistic, especially if you're a long-term investor. And the reality is, whether you're 30 years old or you're 60 years old, you're still a long-term investor. Despite bad things happening, It's undeniable that human progress continues to march on. I know that I wouldn't bet against it. With that said, as always, let's stay on point.